Welcome to Rich Tribe. You know, John, I talk to so many people. Everyday hardworking earners, right? And they are doing literally everything right. They show up to work, they pay their bills on time, but then the end of the month rolls around, and they're staring at their bank accounts, just wondering why building real wealth still feels like an absolute pipe dream. Honestly, it's incredibly frustrating.
So I gotta ask, why does wealth feel so totally impossible for regular folks? Why do some people just seem to effortlessly get rich, while the rest of us stay broke? It's a really great question, Monique. Look, the truth is, most people are entirely focused on this illusion of getting rich quick. They want that one lucky stock pick or a sudden windfall. But the millionaires I know, and the way I built my own wealth, we don't rely on luck. We rely on mathematical reality. So let's break this down. Because building true wealth, it actually has almost nothing to do with your salary. It's about playing by an entirely different set of rules.
To understand how wealth actually works, you really only need to grasp one fundamental difference, and that's simple interest versus compound interest.
Right, so simple interest is just growing in a straight line, yeah?
Exactly. With simple interest, your money grows linearly. You earn a fixed amount year after year. It's just a steady, straight line. But compound interest, that is where the magic happens. That's exponential, accelerating growth. Compound interest means your money makes money, and then those new earnings go out and make even more money. It's like a snowball rolling down a really long hill, picking up more and more snow with every single rotation until it's massive.
Okay, that sounds great in theory, John, but is this just fancy financial jargon? Give me some proof that this is the actual secret sauce to getting rich.
How about Albert Einstein? Pretty smart guy. He reportedly called compound interest the eighth wonder of the world. He actually said, "He who understands it earns it. He who doesn't pays it." He recognized that this wasn't just some boring banking term, it's a fundamental mathematical force in the universe.
And the key to unlocking this math for yourself is the number 72. Monique, let me teach you the rule of 72.
Okay, I'm listening. What exactly does 72 do for me?
Think of it as a millionaire's shortcut. If you want to know exactly how many years it's going to take for your money to double, all you do is divide 72 by your expected annual interest rate. So if you're getting an 8% return, 72 divided by 8 is 9. That means every 9 years, your money completely doubles. And the best part? That happens without you doing a single extra hour of work.
Let me give you a crazy real-world example of this. When Benjamin Franklin died back in 1790, he left a 1,000-pound sterling trust, which is about $9,000 in today's money, to the cities of Boston and Philadelphia. But he put a catch on it. He demanded they not touch it for 100 years. By 1890, it had grown to $500,000, and by 1990, that initial small fund had ballooned to over $6.5 million.
Wait, no way. All from literally just leaving it alone?
Entirely from leaving it alone. That is the sheer, unstoppable force of compounding over time.
Okay, but let's be real here. Nobody tuning in today has 200 years to wait around for their money to grow. How does this help an average person right now? Fair point, absolutely. So the most crucial ingredient here isn't the amount of money, it's time. Let's compare two young investors. First, we have Michelle. She saves $250 a month, but she only does it for the first 10 years of her career. And then we have Matt. Matt procrastinates, starts 10 years later, and saves that exact same $250 a month, but he does it for the next 30 years. Now, the math on this is just brilliant. Michelle, who only invested for 10 short years in her 20s, ends up with over $509,000. Matt, who invested for 30 years, literally 3 times as long, only ends up with about $375,000.
That is staggering. I mean, Michelle contributed way less out of her own pocket, but she completely crushed Matt in the end.
Exactly, because in the wealth game, time absolutely always beats total capital, period. If you look closely at how this growth curve plays out, it's fascinating. In the beginning, your initial investment is doing all the heavy lifting. But look what happens over multiple decades. That cumulative compound interest aggressively outpaces the money you actually put in. The interest begins earning its own interest, and that curve just steepens violently upward. It's a hockey stick effect.
All right, John, you're making this sound almost too easy. If it's just math, why isn't everyone walking around as a millionaire? What's the catch? Well, the catch is that compounding has a dark side. This exact same mathematical force can, and often does, work against you. If you carry revolving credit card debt at 18 to 48%, that interest compounds daily against you. It's literally a wealth-destroying machine. And on top of that, you have average inflation and high investment fees constantly eroding your purchasing power behind the scenes. Remember that rule of 72 we just talked about? Let's use it in reverse for inflation.
Okay, so if historical inflation averages around, what, 3%?
Right, so 72 divided by 3 is 24. That means if you just leave your hard-earned cash sitting under a mattress or parked in some zero-interest checking account, it mathematically loses half of its purchasing power every 24 years. So playing it perfectly safe with cash actually guarantees that you will lose wealth.
You know what else destroys wealth? Just everyday life. I mean, every time I get a raise, my rent goes up, maybe I buy a slightly nicer car, or I start eating at fancier restaurants, the extra money just vanishes.
You just hit the nail on the head, Monique. That is the silent wealth killer. We call it lifestyle inflation. It's when your income goes up 20%, but somehow your spending goes up 22%. It is easily the single biggest behavioral threat to young professionals today. You're earning more, but you're actually saving less.
And this really brings us to behavioral economics. See, in traditional economic theory, we have econs. These are like perfectly rational, calculating robots who always optimize their savings.
Right, but we are definitely not econs. We're humans.
Exactly. Humans are emotional creatures. We have this constant internal conflict. We have a planner in our brains who wants to dutifully save for the future, and a doer who wants that instant gratification right now. And honestly, the doer almost always wins, because we are so heavily present biased.
Is that present bias the reason why people constantly buy stocks when they're sky high and then panic sell when they hit the bottom? Precisely. And that leads to what researchers call the snakebite effect. Let's say a novice investor enters the market, and then a crash happens, like the 2008 global financial crisis. They suffer a massive loss. They feel snake-bitten. So what do? They avoid the market entirely, moving to zero risk, and completely miss out on the incredible recovery that mathematically always follows.
Let's actually look at the ultimate market panic for a second. The 1929 crash and the Great Depression.
Wow. Looking at this data, the dividends barely dipped at all compared to the actual stock prices, and then they just skyrocketed.
Yes! Loss aversion completely blinds people. Notice how the actual stock prices crash, but the dividend growth remains incredibly resilient. Uninformed investors panic and sell everything, but informed investors realize that market panics offer absolute once-in-a-lifetime buying opportunities for rock-solid companies that are still paying out growing dividends.
So we know the math works, and we know our own human emotions are our biggest obstacle. Before I give you the ultimate automated blueprint to beat these traps, please subscribe to Rich Tribe channel. Like, comment, and share. It really helps us bring you more of these actionable insights.
All right, let's look at the actual blueprint to build your wealth. To beat your inner doer, you have to automate everything. First, use automatic enrollment for your investments. Second, use the SMART program. That stands for Save More Tomorrow. This means you commit right now to automatically investing a portion of every future raise you get before you even see the money hit your checking account.
Oh, that is smart. That totally prevents lifestyle inflation. And what about DRIPs?
DRIPs are dividend reinvestment plans. Instead of taking the cash dividends, the system automatically buys more shares of the stock for you. It is the ultimate tool for dividend hypercompounding, taking all human emotion completely out of the equation.
Okay, so if I'm summarizing this actionable blueprint for everyone, Step 1, open a tax-advantaged account like a Roth IRA. Step 2, make sure you are getting every single penny of your employer's 401k match, because that's literally free money. Step 3, buy boring, broad total stock market index funds. And Step 4, automate the whole shebang.
That is the absolute perfect summary. Be boring, get rich. Set up those automatic index fund investments and just step back and let time do the heavy lifting.
And I want to leave everyone with one final piece of proof on why this works so well. When you break the long-term data down, after 30 years of disciplined investing, a massive 90% of your portfolio's entire value is generated purely by compound earnings. Only 10% is the actual money you saved out of your own pocket.
Wow. So the money really does do the work for you, as long as you give it the time it needs to cook.
Absolutely. Compound interest is a universal law of finance. It is happening right now, every single second of every single day. So the only question left to answer is, will compounding work for you or against you today? Are you going to be the person paying the interest, or are you going to be the person earning it? The choice is entirely yours.